Hi everyone. In continuation with basics of financial mathematics, let us discuss a very common word which is used in day-to-day life, that is annuity. Annuity is actually the annual payment which you are making. Like if you are paying home loan or if you are paying LIC premiums, then you are paying a sum of money after equal interval of time, and this sequence of your equal payments after equal interval of time is known as annuity. Now let's discuss some of the terminologies related to annuity. So these are the various terminologies which we use in basics of financial mathematics when we use annuity. First of all, it is periodic payment. So this is actually the payment or the size of each payment of an annuity is called periodic payment. So this is size of payment. Size of payment means the amount which you are paying annually is your periodic payment. Payment period, this is the duration, the time gap between two successive periodic payment. Time gap, this is the time in between two payments. Time gap between two successive payments. All right. For example, payment period of, let's suppose, rupees 1000 is made on every 15th of each month or 10th of each month. So payment period means time gap of two successive payment is your payment period. Now what is this term? Term is the payment counted from the very beginning of the first payment to the end of the payment. That means you can take an example like LIC premium has been paid from, let's suppose, 2009 to 2020. So we are considering from the beginning to the end. That is known as term of that LIC premium. Next is your amount or future value. This is just the investment which you are making today. That means after a certain period of time you will be receiving some additional or extra value. So that is your future value. Capital value or present value? Present value, the amount which you are spending today is your present value. Now these things, net present value, cash inflow, cash outflow, discount rates, these terms are generally used in business. Now to understand net present value, let's discuss cash flow and cash outflow first of all. So cash inflow is the money coming into a business through different sources, through different sources. That means cash inflow means the amount which is coming into a business through different sources. All right. So this is cash inflow. Now what is this cash outflow? Cash outflow means the amount which is going out of the business. That means if the salary is paid to the staff members, then that is counted in cash outflow. All the expenditures that are made for the business are counted under cash outflow. Now lastly, it is discount rate, and this is the rate, or I can say this is investors expected rate of return. Investors expected rate of return. That means after giving a discount, how much he is going to have in his pocket is your discount rate. Now you can calculate your net present value by the formula net present value is equal to sum of all the present values of all cash inflows. So I can make it like it is net present value. So formula will be sum of all cash inflows, that means the money which is coming in the business, minus the sum of present value of cash outflows, sum of all cash inflows and sum of minus sum of all outflows will give you the net present value of the business. Note down all these definitions and you can understand the meaning of these terminologies. Now let's discuss types of annuities. We have three types of annuities, that is annuity certain, contingent annuity and perpetual annuity. The name is only suggesting you that this word certain means at a fixed interval. So annuity certain can be defined as the annuity whose term begins and end at certain fixed date. That means beginning and end point is fixed. Alright, so this is certain. We can take an example like purchase of different products on installments. That means beginning and end is fixed here. That means you have to start from a certain time period with a certain payment and then you will be ending up with a certain payment and at a certain time. Alright, you can also take recurring deposits in your post offices or banks. Okay, that payment you have to make on a fixed date, on a certain date. You have to start on a certain date and then you have to end it on a certain date. That means the maturity period. Second is contingent annuity. So here contingent is your continuous annuity and it is defined as the annuity whose payments continue for an uncertain period. It is continuous but the time period is not certain, the time period is not fixed. For example, purchase of an insurance policy for the marriage of a man's daughter or son. That means the marriage age is not fixed. So he has taken LIC premium for his son or daughter, but since the marriage is not fixed on a particular date, so it is contingent annuity. That means continuously he is making investment, but he don't know the time period at which he has to stop. Then we have perpetual annuity. This is defined as the annuity whose payment begins at a fixed date but continue forever. Here it is continuous but uncertain. Uncertain means no time bar. No time bar, or I can say time period is not fixed. Time period is not fixed. That when daughter or son is going to get married. Alright, perpetual annuity, this is the payment made for ever. Alright, so here the time period is continuous. That means it begins at a fixed date but continue forever. For example, if we take like in college endowment funds, the interest earned is used for scholarships and these scholarships are given every year. So it is not ending at any point of time. So we are saying the payments made forever. That means the scholarships are given every year and it is not ending anywhere. Now we can classify annuity on the basis of time of payment also, and these are categorized in three things. First is your regular annuity. The name is suggesting you Regular annuity means you have to pay it regularly. If you are paying the amount regularly, then it is regular payment. All right, like repayment of home loan is a regular annuity. Second is annuity due. This is an annuity in which payments are made at the beginning of each payment period. When the payments are made in the beginning, that is your annuity due. You must have heard that your installment due date is this. That means this is your beginning date of payment of the installment. For example, a recurring deposit is an annuity due. All right, the first date, the beginning of the payment is your annuity due. Third is your deferred annuity. Deferred annuity means here to postpone. This is the term widely used in business. So this is the annuity in which first payment is postponed for a period of time. Alright. So first payment is postponed. And like it is in business, like a business loan is an example of deferred annuity. Like when a person starts a new business, bank allows the businessman to repay the loan after certain time. That means he has been given some of the time period to pay that particular amount. So the first installment has been delayed. So deferred annuity is your first payment is delayed. So this is your delayed annuity.